Disney is currently trading with a market cap of $306.55 billion US dollars. It's down from its 52-week high of 203.02 cents per share, significantly up though from its 52-week low of $108.02 per share, and it's trading today at $168.73 per share. Now, over the past 6 months, Disney has declined from its high about 16.43%, largely due to broader economic factors such as inflation and just an overall uncertainty in the markets moving forward here. On top of that, they recently had an earnings report last week, which we'll touch on and cover a little bit of, and they also just didn't have the same performance or as good of a performance as some investors expected, especially in Disney Plus growth, which did not meet investor expectations, although we did see growth in other segments. Disney, again, its market cap of $306.55 billion US dollars. Now, over the past year, we have seen a significant recovery, though, despite it trading downward over the past few days, or the past, I guess we could say, the past couple months here. It currently recovered about 47.52% since a year ago, which was around that May, March, kind of April area. We're experiencing lots of just uncertainty in the market with coronavirus going full force by then. This is slightly after the sudden March crash around Valentine's Day, right after February there. Or it was around February 14th through about March. They were experiencing a massive downward trend in the market. But since then, Disney has had an incredible recovery, up over actually 47.52% over the past year. I am bullish on the Magic Kingdom. You heard it here first, folks. This is the DIS. It's a ticker symbol for Disney, currently trading on the New York Stock Exchange. And this is the DIS stock analysis. This is StockerFinance. I'm your host, David Scheuer. Twitter.com/StockerFinance for more information. And the newsletter link will be below if you want to check that out. It's a once per month newsletter. It's pretty awesome. So let's start out. Institutional investors are selling Netflix for Disney, specifically Kathy Woods, a very famous tech investor who's involved with the ARK fund. On top of that, she bought $26 million worth of Disney shares, but she sold $13 million in Netflix. Now, to us, this is a great sign that institutional investors are realizing the innovativeness of Disney, especially Disney Plus, and are slowly moving away from Disney's competitors to invest more in Disney. That's a very good sign for us retail investors that the massive institutional investors who drive a lot of the price power or price movements on these stocks are becoming very bullish on Disney as they've already been. Due to its last earnings report, we did see a couple analysts remove or kind of just slightly lower their rating on Disney. Not that the ratings necessarily matter too much, although it sometimes does affect the stock price in the short term. But the long term, the fundamentals of the company and the company's performance will really is what really is going to drive the share price. But we did see a couple reduce their estimates for Disney stock to about $205, but most of them are around the $200 mark to, there's some as high as $250 as well. Disney's currently trading, again, significantly below that. Now, to go into the specifics here of what ARK did here, they purchased with their ARK Next Generation Internet ETF. They purchased those shares, but they also sold 26,621 shares of Netflix worth about $13.1 million. And they also still own, though, and still holding on to about 11.3 million shares, or not shares, dollars, which is 23,226 shares worth about 11.3 million. There we go, stumbling my words. And for some reason, they're owning that through the ARK Space Exploration Innovation ETF. I didn't know Netflix was involved in space exploration and innovative. Maybe they got something going on behind the scenes or some real advanced movies or something, for astronauts to watch. And I have no clue. It doesn't make any sense, but that's besides the point here. This is about Disney, and I won't be surprised if they sell more shares of Netflix and purchase more Disney moving into the future, just realizing how rapidly Disney Plus is growing, as well as, just Disney's other media segments. Now, Netflix is currently down 12.552% over the past month, with a market cap of $215 billion, the PE ratio of around 60, an incredibly high PE ratio. Now, think about it. If Netflix, which has around 200 million users, or not users, but paid monthly subscribers, is worth $215 billion, and Disney is heading to that direction, will be at that same and surpass Netflix users on its platforms very soon, or on just Disney Plus, actually, very soon in the near future, probably within the next year. Does that mean that Disney should have at least a market cap of $215 billion, not including the park segments, not including all the other segments that Disney has, which can support Disney as a whole and will make the company much more diversified than that of its competitors, such as Netflix? Now, Netflix over the past year has traded relatively flat as well compared to Disney, which recovered 47%. Netflix has only increased 7.495%. Now, let's talk about Disney Plus growth and potential, since Disney Plus is one of the main drivers of this business at the moment. Now, currently, The Walking Dead is moving to Disney Plus, which is a great sign. It's really important to pay attention to what content is coming to Disney Plus, since that is what will drive a lot of the growth. When users and people see, new content coming on a certain platform, they all kind of flock to that platform. Star Wars is on Disney Plus, National Geographic, a lot of good stuff there. For me, it's mainly the Star Wars stuff, as well as for all the Marvel fans out there, a lot of that stuff. There's some good originals. The Mandalorian is one of my favorite shows. Can't wait for the next season or whatever spin-off of that they're making as well. But The Walking Dead, that's a huge show. It's a huge fan base. Moving to Disney Plus in the UK will definitely drive a bunch of individuals to purchase Disney Plus and become subscribers. So we'll see increased growth from that. We also have a bunch of other episodes and seasons and series of shows coming. More, just some of the big ones to name a few here. At Star Wars: The Bad Batch, some episodes, some recently were airing, and they're premiering weekly now in June. I think weekly premiere. So let's just talk about this. If I'm going to slow down, I know I'm talking a little faster. Let's slow down here and focus on something really specific about Disney compared to Netflix. When Netflix releases a show, they release it all at once, sort of so you can just binge it all. The problem with that is that I find with Netflix is I binge it all in one night, or I binge it all in a week, and then I'm done with Netflix. Like, why do I even need it after that point, right? And so a lot of times what we're seeing with Disney, however, is they are releasing stuff on a weekly basis, kind of like you have with more traditional TV, and that's creating the sense of I need to keep my subscription, because if I don't, I'm going to miss the next upcoming episodes. So Disney has really prevented a loss of subscribers due to them getting bored with content, because they keep them interested on a weekly basis. They keep them coming back to their platform. That's really important, and a strategic advantage, in my opinion, for Disney versus that of Netflix. And although Netflix and people love Netflix because they can binge shows, that is also one of its faults. It's kind of a double-edged sword for Netflix, in my opinion. There's a bunch of other movies coming up as well. Got some Marvel Studios stuff, Ice Age, whatever. And let's go ahead and take a look at the subscriber numbers. At 103.6 million Disney Plus subscribers, ESPN Plus subscribers actually beat expectations at 13.8 million, with Hulu hitting 41.6 million. Now, if you look at my estimates, and this is from the newsletter, if you didn't sign up for it, you should, because there's some great analysis on there, as well as stock, just education and information. So I reduced all of my estimates by 10%, and I had to estimate this quarter of 121.17 million. Definitely missed that. As you can tell, they're at 103.6 million, and I was at 121.17 million. I was about 17 million users off, and or subscribers off, I should say. And the reason I was so off is I really underestimated some saturation and simply the summer slowdown. As we move into summer here, the weather gets nicer. People want to go outside. People don't want to stay inside as much. On top of that, we're seeing the COVID lockdowns really stop. People are going out to restaurants again. People are getting busier. That means people will have less time to watch TV, and that means maybe less people are focused on watching, their shows, which means less people may want to purchase or become subscribers to Disney Plus. And on top of that, I just completely underestimated the saturation. 100 million is a ton of people, and it does get to a point where it starts to saturate the market because there's only so many people who can afford Disney Plus. And on top of that, we're still dealing with around 6% unemployment, so the economy is still kind of struggling. People aren't, in the wealthiest spots that they've been in history, that's for sure. So we are, and on top of inflation as well, we're seeing some issues. So yeah, there's a lot going on in the broader economy on a macro scale for sure that's affecting this. And I've just decided to reduce all my estimates by 10%. These are not the reduced estimates. These are the original ones, but I just thought I'd let you know. So yeah, anyways, let's move on here. On top of that, Disney Plus, just to give you some guidance here and just an idea of where they're heading, they originally believed, their executives, that they'd be between 60 and 90 million by 2024. Now they're at 103 million already in a year. And now they're targeting between 300 and 350 million across all of its streaming platforms by 2024. I think that's underestimating it. I think there'll be around 400 million or more, maybe 500 million subscribers across all of its platforms, because Disney Plus especially is growing so rapidly and with so much new content coming out in the future. I think Disney's going to grow a lot faster than even this new estimate there. Now let's dive into the fundamentals of this company, which a lot of you care about, and of course is one of the most important parts of doing any analysis of a company. So let's go ahead and dive into revenue and operating income here. I'm using hypercharts.co. They just compile financial data into really simple and pretty graphs that are great for YouTube videos. So that's why I love to use them. Again, though, the site is hypercharts.co. Definitely check them out if you have the chance. So operating income recovered significantly from the past couple quarters to $1.446 billion, with revenue decreasing slightly quarter over quarter. Not too big of a worry there, although I would like revenue to, recover a little faster than it has been, simply due to the fact that parks are reopening. The broader economy is, still in a struggle, but it's definitely improving overall. We saw GDP increase the past 2 quarters, which is great. And we are seeing unemployment, which did remain flat over the past month, but hopefully that'll continue to decline, which would be a good sign for Disney as well. We're also seeing mask mandates being lifted across the country. Now masks are now optional, I believe, if you have a vaccine or both vaccines. So that's great for Disney as well. Might encourage more people to go out to their parks, although I'm not sure about Disney's policies for their parks. But again, if we can get their parks up and running, we'll see, or fully up and running and fully operational, as well as, movie theaters and such, we're going to see a significant increase in revenue as well as operating income. I would just like revenue to start rebounding a little faster for a $300 billion company. Net income saw a major recovery, though, and we're going to take a look at its margins in a second. Increased to $901 million this quarter in net income, and their operating expenses actually decreased. Now, this is actually a really good sign, I think an overlooked sign for this past quarter. And the reason I think it's overlooked is because they're recovering right now. They're opening all their parks. They're getting stuff going again. They're producing tons of content, yet their cost and expenses decreased. And their net income drastically increased, which means their margins are significantly improved. And so we have their profit margin increasing to 5.77%. I suspect and expect that to continue to grow over the next couple quarters. We have operating margins also increasing to 9.26%. Their cash on hand right now around 15, a little over around 16 or 17 billion US dollars, decreasing from the past few quarters. I'm not too worried about, though. They're still in a healthy financial position. Their cash on hand is not getting drastically low or anything like that. It's still fairly high for Disney. And they're spending a lot of money trying to get everything reopening. But again, their expenses decreased the past quarter, which is great news overall for their profit margins and for their bottom line. Let's take a look in the change in cash and cash equivalents. They decreased by about $1.18 billion. And free cash flow, if we take a look at that here, $623 million. It's great. Obviously, on a year-over-year basis, we are seeing a little bit of a struggle there. $1.9 billion in free cash flow, March 28th, 2020 to April 3rd, 2021. We're seeing $623 million in free cash flow. But what are you going to do? Their whole business was hurting drastically. Disney Plus does create significant amount of cash flow, but the margins on that are very slim, although they will continue to increase prices due to inflation, as well as due to the fact that they can, because people are getting hooked on the site, and that's going to lead to a massive increase in free cash flow there. Disney Parks and Experiences, we see a loss of $406 million compared to $756 million, which was not a loss in March 28th, 2020. As the parks start to reopen and get going again, I expect this to change over the next couple quarters, so I'm not too worried. 6 months ended. It did a little better compared to $525 million. So that's a good sign. But yeah, I don't know. Not too much to worry there. I just do want the parks to open faster. I feel like things are starting to move a little slow for Disney, and I don't want that to happen. Let's take a look at its balance sheet here. Really pay attention to the very bottom of it, which you can see is total Disney shareholder equity. That increased to $85.5 million, which from a year ago was $83.5 million. That's showing that even though they have experienced significant financial hardship, they are increasing their shareholders' equity overall, which means their total assets are increasing faster than their total liabilities. That's a great sign for the overall financial health of the company. Disney is currently trading again at $168.73 per share. Overall, to give you a summary of my analysis here, I know it was very brief and just kind of a broad summary of this company. I think Disney's in a great position, and I think they're primed and ready to keep growing. I know we saw a slight slowdown in growth from Disney Plus, but that doesn't mean it decreased. They're still growing, and it's going to continue to grow. Again, I think the slowdown is primarily due to the fact that people are getting outside and just not spending as much time as they were during COVID on their computers. People want to vacation, want to go places, and maybe that caused a few people to cancel their Disney Plus. Or if anything, I don't even think that's the case. People just don't want to watch as much TV, so they're going to maybe buy it later on. But I expect as we go into the next couple quarters, especially next year, and we hit the kind of holiday season again, when they're releasing tons of new content around that time, we're going to see a massive increase in influx in Disney Plus subscribers and all of their, Hulu and ESPN Plus, I think, as well. So, yeah, I think it's a good sign for Disney. I'm very bullish on this company. They're in a fairly healthy financial position while their competitors, such as Netflix, are struggling right now. We're seeing institutional investors continue to purchase shares of Disney. Analysts, they are changing their price targets, but all the price targets really, that I've seen are in healthy spots, although I really try not to pay attention to price targets too much, and I chose to do my own analysis of the company. Anyways, guys, this is StockerFinance, though. I'm your host, David Scheuer. Thanks for watching. Please subscribe. I hope you enjoyed this video. Twitter.com/StockerFinance. Make sure to follow me there. I got some good tweets coming out these days. Check out these videos as well. And if you want, subscribe to the newsletter. The link will be below. Just requires your email. That's pretty much it. And it's once per month, so it's not a spammy email. Comes with a bunch of interesting content. I'm not trying to sell you anything. I just like writing the newsletter, and it's a really fun thing for me to do. So definitely check that out. I put a lot of work into it. Anyways, this is StockerFinance. I'll see you in the next video. Peace out.